In this video, I am going to go through the accounting rate of return and explain its use. Okay, the formula. Accounting rate of return, it's abbreviated ARR, is an investment's annual income, right? Again, annual income is not cash flow. So we're moving from cash flow that we were using in the payback period. Now with the accounting rate of return, we're using income, not cash flow. Meaning we're going to include depreciation as a deduction to overall profit. Okay, so again, it's annual income divided by the average amount invested. So the average amount invested, boy, I feel like maybe doing this. Okay, so again, average income, let's just be clear that includes a deduction for depreciation. Okay, and then average investment, okay, that formula is going to be the initial investment plus the salvage value, meaning the amount that we anticipate we can get at the end of the asset's useful life, divided by 2. And so what we're saying here, the average investment, if you think about we acquire something, let's say that we acquire something, I'm going to make it super simple. We spend $10,000 on equipment and it has no residual value, okay? Therefore, the asset's going to depreciate from 10,000 down to 0. And what we're saying is the average investment is the midpoint between the initial investment and the salvage value. And we don't even have to do any crazy math. It's 5,000, okay? The formula is going to be 10,000 is the initial investment plus 0 divided by 2, okay? All right, now we can go back to the slide. So in this particular example, they're basically saying, hey, we can purchase a piece of equipment for 16,000. It's going to have some useful life. Then at the end of its useful life, there will be no salvage value. All right, so the formula, initial investment plus the salvage value divided by 2. So in this particular example, our initial investment is 8,000. All right, so now we can do the accounting rate of return. So if my annual income is expected to be 2,000 a year and my average investment is 8,000, then the accounting rate of return is 25%. Okay? Seems pretty straightforward, and it is. Okay, the weaknesses of the accounting rate of return is, again, we're ignoring the time value of money, and we'll get into that in the next video. And then it does not consider cash flows and their timing, right? So again, we're not using cash, we're using income. And there is a complexity that I do want to address that's not part of the PowerPoint slides. Let's say that I'm just going to make it up. Let's say the initial investment for a particular product is 20,000. Okay? Our cash flow, our anticipated cash flow is going to be 4,000. Useful life is going to be 8 years. Salvage value. Ooh, man, I'm going to just say 2,000. What is the average annual income? And what is the accounting rate of return? In this particular example, right? So again, they're giving us, or I'm giving you cash flow, but I am not giving you income. And if we remember correctly, the formula is average income divided by average value. Okay, so let's do average income. So, average income. I'm gonna make a total of 4,000 every year times 8 years. That would be, I think, 32,000. And I am also going to get a $2,000 cash payment at the end of the 8 years. So the total cash that I am expecting to generate from this asset, 34,000. Okay. But again, we need average income. So what I would do is I would then subtract all of the anticipated depreciation. So all of the anticipated depreciation, we're going to go from 20,000 down to 2,000, and therefore total depreciation 18,000. And I can just quickly draw that, right? We have a $20,000 initial investment, and it's going to decrease down to 2,000 over that 8-year period. And therefore the total depreciation is going to be 18,000. So I could subtract 18,000 from 34,000. I can just call this depreciation. And now I have total income. The total income would be, what is that, 16,000? Oh man, this is awesome. Total income. However, we need average annual, so then I would just divide it by 8 years, the useful life, and I would get 2,000 average annual income, right? That's the numerator. And then our average investment in this particular example, remember we said we would take the initial investment of 20,000 plus the salvage value. In this example, it's 2,000, and we would divide that by 2. So 22,000 divided by 2, 11,000. So that's the worst looking fucking 11 I think I've ever seen. So 11,000. So what is 2,000 divided by 11,000? I'm coming up with approximately 18% accounting rate of return. Right? So in this particular example, I have an accounting rate of return of 18%. The book gave us an example where we had 25%. We want to clearly pick the one with the higher accounting rate of return. So in this particular example, I would go with 25%, this investment, over the one that I just made up on the other slide, because 25% is greater than 18%.